Too many people get caught up in the day-to-day, in the newest news, in the CPI inflation numbers, in whatever kind of articles get published around crypto. But what really is important is the long term. And what's interesting about this is that we see long-term trends changing. What used to be very common, very popular investment advice just 20, 30 years ago has completely flipped today. In this video, I want to talk about the changes that happened in the past and about the likely changes that will happen in the future. It's very important not to get caught up on the wrong side of history, because then things, of course, don't turn out too well. Now, here is where a lot of people got caught off guard. It is the 60-40 portfolio. This was a very common advice not too long ago, to own 60% stocks and 40% bonds. Nowadays, nobody wants to own bonds anymore, right? Nowadays, people own stocks, ideally technology stocks, potentially some crypto, potentially some gold, but bonds are pretty much out of favor. Now, why did they fall out of favor? And does it potentially make sense to buy them today, right? We should always buy the thing apparently that nobody wants to buy. We want to be contrarian. Does it maybe make sense to sell some Bitcoin and buy some bonds? Let's have a look at some data. This here is TLT. So this is a long-term government bond exchange traded fund, an ETF. The chart starts in 2002 and prices developed very, very nicely up until the year of 2020. Long-term bonds more than doubled to then come crashing down when monetary tightening was introduced again. Over those more than 2 decades, prices increased by only 8%. But on top of the price development, there was also coupons, an average of 4% per year. Now, what was the idea behind this 60-40 portfolio? Why did people buy bonds with 40% of their wealth? This here is the reason. What we see in red is the S&P 500. And again, what we see in green is TLT, so our long-term government bond ETF. Of course, stocks outperformed long-term. But the reason to also own long-term government bonds is as a protection against potential stock market crashes. So have a look over here at the global financial crisis. Long-term government bonds went up in price, or have a look at the COVID crash over here. Again, long-term government bonds went up in price. Now what we see here at the bottom in white, that's the 1-year correlation coefficient of long-term bonds versus stocks. When this white line, the correlation coefficient, moves between +1 and -1, it's randomly fluctuating. That means that the price development of stocks and bonds aren't connected. In other words, if stocks crash, the bonds can potentially go up. But what exactly has happened? Why isn't the new generation buying bonds anymore? Why are bonds now just a thing for institutional investors? And why are the young folks just buying crypto and stocks? The reason is that bonds long-term underperform. And that underperformance is not just sporadic and random, it is very, very constant. Have a look at this chart here. This is TLT relative to the S&P 500. In more than 2 decades, long-term government bonds underperformed stocks by 85%. If you were not afraid of the volatility, if you bought 100% stocks instead of 60% stocks, 40% bonds, you would have made 7 times more money on that 40% bond allocation. Now, the issue is, of course, if we only own stocks or if we only own Bitcoin, that we don't have any protection whatsoever. If things crash, things can be very, very nasty, and that's why we want to be diversified. But then the question is really the bond market the right place to invest? Is there maybe better ways to hedge ourselves against a potential crisis? And as I believe what history has shown, this is what the new generation has learned. The better hedge against a potential crash is not the bond market, it's probably the gold market. Because while this is the relative performance of long-term government bonds to the S&P 500, this here is the relative performance of long-term government bonds relative to gold. And that is an underperformance of 89%. So had you bought in the year of 2002 some gold instead of long-term government bonds in order to protect yourself against a crash, you would have almost 10 times more money. And it's very hard to argue with this, that gold is more risky than long-term government bonds. The performance of a portfolio of 60% stocks and 40% gold would have been way better than 60% stocks and 40% long-term government government bonds. But let's spin this further, right? We can have a better risk-off part in our portfolio by buying gold instead of long-term government bonds. Or we can also be a bit more specific with the stocks that we buy, because not all stocks perform equal. Have a look at this long-term chart. This is the Nasdaq 100 relative to the S&P 500. Again, a very long-term chart. It starts in 1985, so this is 40 years of data. And technology stocks outperformed all other stocks, the regular stocks, by a 5x. Yes, we do have a bit more volatility over here. This is the .com bubble crash. So first our run up, then our decline. But long-term technology stocks or growth stocks tend to do better than all other stocks. There's more and more of the economy that moves towards tech. And then of course we can even go one risk level higher. Instead of buying stocks or technology stocks, we can buy some Bitcoin as well. And we all know how Bitcoin outperformed pretty much everything else in the last decade. What we've got over here is the Bitcoin price relative to the Nasdaq 100. And of course, initially when Bitcoin was small, it outperformed the Nasdaq 100 or technology stocks very, very quickly. This outperformance isn't as quick anymore. So over here, this is when Bitcoin was at $20,000. Now it's close to $100,000, but the outperformance relative to the Nasdaq 100 was only 50% during that time period. So over the last 7 years, roughly. 50% additional performance over the course of 7 years is an alpha of 5.9 or roughly 6%. Now, what exactly is happening over here? Why is the world in general getting more and more risk on? In the early days, people had just cash and long-term government bonds and maybe a house that then got paid off. Then afterwards, people bought more stocks. Then afterwards, people had like their 60-40 portfolio. Then people tended to buy more and more stocks, less and less long-term government bonds. Afterwards, now people are getting into crypto, right? Into Bitcoin. What fundamentally has changed? Why are people comfortable with more and more risk when investing? I think the answer lies into how capital ownership has changed over time. Have a look at this chart here. This is the median household income in the United States. And this went from $22,420 in 1984 to $80,610 in 2003. So roughly a 4x, a bit less than a 4x over that time period, 39 years. How quickly did household income increase over that time, right? The typical household. The growth rate over the 39 years is 3.3% per annum. Now, how much did house prices increase over the same period? The answer is over here, a bit more than a 5x or growth rate of 4.3%. How much did the S&P 500 increase during that time period? The answer is 8.9% per annum. But here we start with the first issue. The growth rate of the S&P 500 in the last 39 years was probably above average in the very, very grand scheme of things. I do not believe that 8.9% per annum is what's going to happen in the next 10 or 20 years. Let me show you why. What we've got over here is the Shiller PE ratio. So this is a 7-year moving average of how expensive companies in the US are, so the market cap of the US stock market. And we're putting that into relationship with the earnings of the companies in that same stock market. Whenever we're buying a stock, we get a fraction of a company. We're buying the future earnings of that company. So the higher the PE ratio is, the more we have to pay for those future earnings, the more expensive the stocks are. And again, this is a very, very long-term chart. This starts in 1871. And we can see how the price to earnings ratio is fluctuating in somewhat of a stable corridor. What we've got over here in the 1930s, that's the Great Depression. What we've got over here in the 1970s is the oil crisis. Then we've got the .com bubble burst. Then we've got the global financial crisis. And now we are close to all-time highs. Our household income chart starts in 1984. That's over here on the Shiller PE ratio chart. So stocks got way more expensive during that time, and they might come down again. Let's adjust the S&P 500 return with that Shiller PE ratio. So the Shiller PE ratio went up by 3.12x or 3% per annum. And so when we adjust the S&P 500 with that Shiller PE, let's say stocks were not more expensive now compared to our beginning of our household data set income, then the S&P 500 would have only produced 5.8% per annum. So not 8.9, only 5.8. That is over the very long term, over the macro cycles, the long-term expected return. Now, there is something interesting about this. More on this in a second. First of all, here's the Nasdaq 100, right? We already looked at how the Nasdaq 100 outperforms the S&P 500. Technology stocks tend to do better. The growth rate is 13.1%. But here's what I actually want to show. This is USM2. This is the money supply. So that's this chart over here. The reason why houses go up in value, the reason why gold goes up in value, the reason why a lot of stocks go up in value over time is not necessarily because those things become better with time, right? It's still the same gold coin. It's still the same house. The reason why the prices go up is because the money gets devalued over time. Over time, there's more and more money that's flowing around. The money supply is going up. And that is measured in this chart. The US money supply goes up by 5.9%. Now, isn't that fascinating? The PE adjusted S&P 500 makes pretty much the exact same performance as the US money supply expansion. What we're really doing when buying stocks in general, if you own all the stocks in the US, we're simply just protecting ourselves against the money printer. We are not necessarily getting more purchasing power, at least if all we buy is American companies. Of course, relative to consumer goods, we do get more purchasing power because consumer goods over time get cheaper and cheaper to produce, right? There is technological progress. But when it's about buying a share of the economy, money devalues by 5.9% per annum, and that's how much companies become more expensive over time. So what exactly is going on here? Why do people not buy bonds anymore? Why do people get more and more risk on? Why is now Bitcoin the best performing asset and is likely going to continue to be the best performing asset in the near future? I think it's because capital concentrates more and more among the rich, and the poor people or just the average person cannot keep up. Again, household income does not grow as quickly as monetary expansion. If you own an average business in the US, you will go up in wealth by 8.9%. If you are just employed somewhere, your income is increasing only by 3.3%. And again, if you're not getting ahead by 5.9% every year on average, if you don't make more by 5.9% every year, you are falling behind. You are falling behind the people that own businesses or that have very cheap debt. And when we look at these numbers, things start to make sense. For example, houses don't become more desirable over time. They rather age, and a new house is always better than an old house. So the median house, why is it going up by 4.3%? It's because of the money supply. In real terms, right? If we had a constant money supply, if the money supply would not grow, then a house is actually losing 1.6% value every year. If you put your money in a fully paid off house instead of the stock market, you are foregoing 1.6% return every year. Now again, this can of course be very different in the next 10 to 20 years because stocks currently are very expensive, but still, right? If we look at this very long term, over the next 100 years, the statement is likely true. When there's that much pressure, when the median household is falling behind by 2.6% every year, which means the purchasing power is getting cut in half every 30 years, so every generation, then things become quite important. They become quite urgent, right? The parents had it twice as easy as our generation, and the next generation will it again have 2 times harder compared to us, just because selling time long term is not an option. And it doesn't make sense, right? There is globalization, there's a lot of cheap labor, especially the well-developed countries. They need to skill up faster than we can expand the labor supply globally, which is pretty much impossible, right? If you have a programming job and then this programming job can be made way cheaper, say in India somewhere, then it's just normal that in the end, the majority of those kinds of jobs will not grow as quickly in their income. And the more labor can be performed remotely or is not even needed because of AI automation, the less income will rise. This is very likely a trend that will continue over the long term. And so the only escape is to buy things that are more risky, that long-term outperform. For example, technology stocks, or as I often discuss here on this channel, crypto, right? Bitcoin. And this is the fundamental reason why I believe that Bitcoin is here to stay. Of course, the volatility will also prevail. We will see our occasional crashes. Bitcoin will go down by 30, 40, 50, maybe 60%. This will continue to happen because people need to take profit every now and then. But as long as there's no replacement for Bitcoin, as long as there's no asset class that's even more risky that can also be adopted globally, I think Bitcoin Bitcoin will continue to see adoption by long-term holders. The outperformance versus technology stocks isn't really that much anymore. Again, it's 3 percentage points, but that comes on top of already our 13%. So we've got roughly 16% nominal return or 10% real return buying Bitcoin, say over the next 5 to 10 years probably. Of course, we now talked 100% about completely passive approaches, right? We just hold the asset and we keep it running. There are, of course, ways to still outperform various markets. If we know, for example, the property market, we can buy very cheap houses. We might fix them up. We might be able to rent them out, then maybe get them appraised higher. We can play the property game. If we know the stock market well, we can potentially buy the high flyers of tomorrow. And of course, with the crypto market, it's the same. And the reason why I run a YouTube channel on crypto and not on any other market is because I still believe it's the least efficient of all the markets. It's still a developing market. It's still possible to ride the waves. It's still possible to use trends. And the vast majority of assets in crypto still have predictable price developments. Most altcoins underperform Bitcoin, for example. So the way I make currently my money in crypto is I don't try to find the one needle in the haystack, the one altcoin that makes a 10x. I'm simply just betting on many altcoins doing worse than Bitcoin. In the last year, for example, 80% of the top 100 altcoins did worse than Bitcoin. They underperformed Bitcoin, even though Bitcoin itself went up, right? It went up by roughly 80-90%. So if you want to dive a bit deeper into generating additional alpha on top of just buying and holding Bitcoin, then feel free to check out the premium membership. It's down below. It's letbitcointrade.com. If your portfolio is at least $5,000, you should be able to make the money back. On top of that, there's also a 7-day money back guarantee. So in case you don't like premium, just message me within the first 7 days and I refund you 100%. There's really zero risk for you. Looking forward to seeing you on premium or potentially here on YouTube as well. If you want to support this channel, feel free to give this video a like. It helps the channel grow. See you next time. Cheers.